So, what's the real difference between a professional financial analyst and, just a speculator playing the market? And what does it actually take to manage wealth, not just chase a hot stock tip? Well, it's not about having a crystal ball, that's for sure. It's about having the right tools. So, let's open up this toolkit and see exactly what's inside. Here's our game plan. We're going to break down the 5 essential parts of the analyst's toolkit. We'll start with the most important piece, the ethical foundation. Then we'll get into the analytical tools and the economic big picture. After that, we'll tackle valuation, and finally, we'll see how it all comes together to build a portfolio. All right, first things first. The most fundamental tool in the entire kit has absolutely nothing to do with numbers or spreadsheets. It's all about the bedrock of the entire profession, ethics and trust. Seriously, without this, everything else just falls apart. And this is such a critical distinction. We're not just talking about a job here. We're talking about a profession. And what makes it a profession is this framework, this commitment to a code of conduct that builds trust. It means serving clients in society first, which is a way, way higher bar than just having a particular skill. So how does that work in the real world? This is where theory becomes practice. When an analyst hits a tough spot or a gray area, they don't just wing it. They use a repeatable process, a framework just like this one. It's a structured way to make sure their decisions are sound, defensible, and always put in the client's interests first. And here are the rules of the road. These aren't just, nice ideas or suggestions. They are the absolute core tenets. Putting client interests first, dealing fairly with everyone, and never, ever acting on inside information, these are totally non-negotiable. They're what keeps the whole system of capital markets running with integrity. Okay, so with that ethical foundation firmly in place, now the analyst can start picking up their diagnostic tools. This next part of the kit is all about learning to speak the language of business, reading financial statements to get a real diagnosis of a company's health. So take a look at this. You've got 2 big companies and 1 small one. How on earth do you compare them on an apples-to-apples basis? Well, you do something called a common size analysis. You just turn everything into a percentage of sales. And suddenly, boom, you can see that the little guy, company C, is actually just as profitable as the giant company A, and way more profitable than company B. It's a super powerful way to see what's really going on behind the raw numbers. A good analyst never just looks at a single number, like return on equity, and calls it a day. Nope. They break it down. They want to know why. Is the ROE high because the company has amazing profit margins, or are they just super efficient with their assets, or are they just loaded up with a ton of debt? See, each one of those answers tells a completely different story about the quality of that return. And the analysis gets even deeper. A pro needs to understand the entire shape of an investment's returns. Skewness tells you if you're looking at a pattern of lots of small wins and a few huge losses. And kurtosis? That's the one that warns you about fat tails. Basically, a higher than you'd think chance of a crazy extreme event happening. It's about understanding all the risks, especially the ones hiding in the corners. Okay, so we've put the company under the microscope. But here's the thing. No company exists in a vacuum. So the next tool in the kit involves zooming out. We need to look at the big picture, the economic map where every single business has to find its way. Analysts are kind of like economic detectives, always on the lookout for clues. They use leading indicators, like the number of new building permits, to get a sense of where the economy might be going. Then they use lagging indicators, like how long people are unemployed, to confirm what's already happened. Piecing it all together helps them anticipate big shifts in the business cycle. And then you've got the 2 huge levers of power that shape everything. You've got monetary policy, which is run by the central bank. They control interest rates. And then you have fiscal policy, run by the government. They control taxes and spending. The moves these 2 make basically create the economic weather that every company has to sail through. And now we get to the million-dollar question. We've diagnosed the company's health. We've read the economic map. So now it's time to pull out the valuation tools and figure out, what is this thing really worth? This is where the science really meets the art. A smart analyst never, ever just relies on one method. That's a rookie mistake. Instead, they triangulate a value. They'll use a present value model to estimate the intrinsic worth from its future cash. Then they'll check a multiplier model to see how it stacks up against its peers. And maybe they'll use an asset-based model as a sort of floor value. Using all 3 builds a much stronger, more defensible case. So let's look at a classic model. Now, this formula might look a little intimidating, but the idea is actually pretty simple. The value of a stock today is basically its expected dividend next year, divided by the difference between your required rate of return, that's the R, and the company's sustainable growth rate, G. It's all just a balance between cash, risk, and growth. Now let's contrast that with a bond. The basic idea is the same. We're still calculating the present value of future cash. But with a bond, those cash flows, the regular coupon payments, and the final principal are locked in by a contract. This makes the whole valuation process a lot more straightforward because there's way less guesswork about the cash you're going to get back. All right, we're at the final step, putting it all together. The analyst has done the ethical check, the financial diagnosis, the economic deep dive, and the valuation work. Now it's time to synthesize all of that into one coherent strategy and build an optimal portfolio for a client. A really crucial idea here is that there are two kinds of risk. There's non-systematic risk, which is specific to one company, like a product recall. You can and you should get rid of this by diversifying. But then there's systematic risk. That's the big stuff that hits the whole market, like a recession. You can't escape it. And here's the key. Modern portfolio theory says you only get compensated for taking on the risk you can't avoid, the systematic kind. And really, this one sentence is the North Star for the whole entire process. The job, at its core, is to build a portfolio that gives you the absolute best possible return for whatever level of risk you're willing to take on. That's it. So how do you actually do that? Well, step one is to map out every possible optimal combination of risky assets. This map is called the efficient frontier. You can think of it like a menu of all the best possible portfolios you could ever build if you were only using risky ingredients. But this is where the magic happens. Once you find the single best portfolio on that frontier, you can then mix it with a risk-free asset, like a boring old government bond. This creates a brand new straight line of investment options called the capital allocation line. And this line is better than anything on the old frontier. From there, the client's personal comfort with risk determines their perfect spot on that line. Of course, none of this is set in stone. This traditional toolkit is always evolving. And today, with the rise of fintech, analysts are adding powerful new technologies to their arsenal, and it's changing the whole game of how investment decisions are made. And that really leaves us with a big question for the future. You see, the analyst toolkit has never been a static thing. It's a living, breathing discipline. So as things like AI and machine learning become a core part of finance, what's the analyst of tomorrow even going to look like? What new tools will they have to master? That is the challenge, and honestly, the opportunity for the entire profession.